If you want to learn about the power of ETF investing and which Vanguard ETFs are best, then continue watching. In this video, you will learn what is an ETF, the advantages of ETFs, why invest with Vanguard specifically, and the 5 best Vanguard ETFs. I'm Sean, I teach personal finance and investing on this channel. Let's dive in. An ETF stands for Exchange Traded Fund. It's a basket of stocks, bonds, or commodities that investors like us can buy and sell just like stocks. An example of this is Vanguard's VOO, which is the S&P 500 ETF. Buying a share of Vanguard's VOO means that you become a shareholder of the top 500 US companies. Pretty cool, right? Instead of purchasing a stock of a single company, by buying Vanguard's VOO, you are purchasing fractional shares of the top largest 500 US companies. Purchasing an ETF allows you to easily diversify and not put all of your investments and hard-earned money into one basket. There are many different kinds of ETFs out there, ranging from sector-specific ETFs that follow certain industries such as the healthcare industry, innovation technology, or bonds. Later in this video, I'll specifically share Vanguard's options for ETFs. ETFs have a lower minimum requirement than mutual funds and low-cost index funds. I took a look at Vanguard's mutual fund with the highest minimum requirement and came across the Vanguard Information Technology Index Fund Admiral Shares, VITAX. It has a minimum investment requirement of a whopping $100,000. There's an ETF version of this, VGT, which you only need the market share price of it, which at the time of making this video is around $303. And better yet, if you have fractional shares with Robinhood, M1 Finance, Fidelity, or any other investment platform, you can invest in this ETF with as little as 1 penny. When it comes to options, ETFs reign supreme. While there are technically more mutual funds than ETFs offered, the umbrella of ETFs is more encompassing. With both mutual funds and ETFs, you can buy traditional indexes such as the S&P 500 or the total US stock market. But the ETFs go one step further and allows you to purchase sector-specific funds. With an ETF, you can gain niche exposure into a variety of areas, including commercial real estate, commodities like gold, the financial sector, and the airline industry. Both mutual funds and ETFs are subject to capital gains taxes and taxes on dividends. However, with a mutual fund, the managers constantly buy and sell stocks in hopes of beating the stock market. When mutual funds buy and sell or rebalance their holdings, they trigger capital gains taxes. With an ETF, you are only taxed when you yourself sell that ETF. You can control how many shares you want to sell and ultimately control how much money you are going to be taxed on. ETFs are simple to purchase. If you have enough money and have any investment app, you can buy ETFs. So why Vanguard's ETFs over any other companies? The founder of Vanguard, John C. Bogle, founded the first index fund in 1975. Since then, Vanguard has offered some of the best low-cost index funds in the entire world. The reason why Vanguard is able to offer such low fees is because they are not obligated to any outside investor. Outside investors demand returns, and those returns are generated by high management fees. Vanguard is actually owned by its funds, and those funds are owned by its shareholders, everyone who invests in Vanguard funds. Vanguard's philosophy puts us, the investors' interests first, which I think is phenomenal. Vanguard also has no commissions on its ETFs. They offer lower fees where on average Vanguard's ETFs expense ratios are 76% less than the industry average. On top of that, Vanguard is awesome at lowering taxes. 86% of all Vanguard ETFs have had no taxable capital gains distributions in the past 5 years. Alright, so moving on to number 5 of the best Vanguard ETF. The Total Bond Market Index Fund, BND. A bond is a loan to a company or government that is paid back over a period of time. Think about it as an IOU between a lender and borrower. It doesn't grow as quickly as stocks do, but bonds are much more stable. The stock market is volatile and goes up and down constantly, where bonds are a steady increase over time. BND is an all-in-one shop for bonds. BND holds US Treasury bonds, corporate bonds, mortgage-backed securities, and more. The expense ratio of BND is 0.035%, and just as a rule of thumb, anything below 0.2% is a good expense ratio. Over the past year, BND has returned 10.49%. On average, over the past 3 years, it's returned 5.76%, for 5 years, 4.5%, and for 10 years, 3.84%. And since inception of the fund in 2007, it has returned 4.61% every year on average. Why is this fund good, and why do you even need bonds? Bonds are a great addition to an investment portfolio when you want to add some stability into the mix. Once you reach the phase in life where you need to draw out money from your investments to fund your life, then bonds is crucial to combat the volatility of the stock market. You don't want to be caught in a situation where you have 100% in stocks and then the stock market plummets and you need to eat those losses to simply get food on your table. That being said, bonds is something you should only add to your portfolio when you are near retirement, from 10 to 15 years out. As a young investor with decades out before retirement, it's better to be more aggressive and have 100% in stocks. They're much more volatile, but since we don't need that money anytime soon, the dips don't matter and we can benefit from the long-term performance of stocks over bonds. Vanguard's ETF number 4, the S&P 500 VOO. VOO invests in stocks within the S&P 500 index, representing the 500 largest companies within the United States. The goal of VOO is to simply track the S&P 500 index, no more, no less. In actuality, it holds 509 companies where the 10 largest holdings are Apple, Microsoft, Amazon, Alphabet, otherwise known as Google, Facebook, Johnson & Johnson, Berkshire Hathaway, Procter & Gamble, Visa, and JP Morgan Chase. The 509 companies cover different sectors in the market, with the top sectors being information technology and healthcare. Over the past year, VOO has returned 11.87%. Over the past 3 years on average, it has returned 11.94%, then 5 years for 11.44%. And the fund is 1 month shy of being 10 years old, but since inception of 2010, it has returned 14.02%. Investing in an ETF that tracks the S&P 500 is a fantastic way to diversify across the top largest US companies. By purchasing one share of VOO, you're purchasing fractional shares of the 500 companies within the fund. And to be honest, it's incredibly difficult to determine which companies are going to rise and which ones are going to fall within a year. So it's better to diversify across many different companies. Just own all of them. One could say in a capitalistic economy like the United States, larger companies have the time and resources to get ahead of the competition, especially during troubling times. If you believe in the growth of large US companies, then this ETF is fantastic. Vanguard ETF number 3, the Total International Stock Market VXUS. VXUS tracks the FTSE Global All Cap X US Index, aka non-US companies. It offers investors a diversified way in purchasing non-US stocks. The fund contains companies in both developed and emerging markets. Developed markets are characterized by economically advanced countries and a higher standard of living. Think of countries such as Canada, Japan, Australia, and those in Western Europe. On the other hand, emerging markets contains companies that are in a period of rapid growth and development but have a less mature market. Emerging markets include countries such as Brazil, Russia, India, and China. The top 10 holdings of VXUS includes well-known international companies such as Alibaba, Nestle, Samsung, and Toyota. The expense ratio of this fund is 0.08%. Over the past year, it has returned 1.41%. On average, over the past 3 years, 1.17%. Over the past 5, 3.31%. It has not been around for over 10 years, but since inception of 2011, it has returned 3.20% on average. I gotta be honest. In recent times, international companies have not performed as well as the US stock market. So why not just stick to investing in US companies? I was concerned about this myself and found this Fidelity article on why you may want to include international companies. The graph displays the best performing developed stock markets during the past dozen years. And what you can determine out of this is that the US outperformance against international companies or vice versa is cyclical. For several years, one will perform better than the other, and then it will inverse. It's challenging to know exactly when this will be, which is why it's important to have international companies within your portfolio so that you don't miss out on when it comes time when international companies soar. Plus, diversifying your portfolio even further can't hurt. It's challenging to pinpoint exactly when this will be, which is why it's important to have international stocks in your portfolio so you don't miss out on those gains when it comes time for international companies to soar. Number 2, the Total US Stock Market Index Fund, VTI. Within VTI is every single US company that's publicly traded on the stock market. It contains 3,529 US companies ranging from small to mid to large cap companies. It includes every single industry that US companies are in, including information technology, financials, and healthcare. VTI is a market capitalization weighted fund, which simply means that larger companies with higher value in the stock market make up a larger percentage of the fund. So actually 80% of VTI is simply VOO, where the 500 largest US companies make up 80% of VTI. And the remaining 20% includes the other large cap companies as well as small and mid cap companies. VTI has an expense ratio of 0.03%. Over the past year, VTI has returned 10.82%, on average over 3 years, 11.36%, on average over 5 years, 10.87%, for 10 years, 13.58%, and since inception in 2001, it has returned on average 7.48%. VTI is the bread and butter of my investment portfolio. It contains every single US company, which is a great way to diversify across different levels of company sizes and different industries. Many investors try to outperform the stock market, but in actuality, over the long run, 95% of financial professionals can't even beat the total US stock market. That, and for additional reasons outlined in this video here, is why I heavily invest in VTI. The Information Technology ETF, VGT. VGT contains all US stocks that are in the information technology sector. It includes stocks that serve the electronics and computer industries or that manufacture products based on the latest applied science. It holds 328 companies where the top 10 largest holdings are Apple, Microsoft, Visa, MasterCard, Nvidia, PayPal, Adobe, Intel, Cisco, and Salesforce. It has an expense ratio of 0.1% and over the past year has returned a whopping 36.9%, on average over the past 3 years, 27.75%, over the past 5 years, 23.82%, 10 years, 20.12%, and since inception in 2004 has returned 12.25% on average. It's probably no surprise to hear that the tech industry within the United States has been booming and doing exceedingly well. Investors who got in on this technology rise has benefited greatly by profiting on their investments. Like I said before, it's really difficult to pick winning companies. You just never really know which companies are going to perform or underperform. But with investing in an ETF like VGT, you are diversifying across 300 different tech companies. In fact, the information technology sector makes up the largest portion of VTI and VOO, which means that the IT companies are valued the highest in the stock market right now. If you're someone who believes that the tech industry is going to continue to grow at a rapid rate, then investing in VGT may be a good fit for you. I've shared different ETFs that Vanguard has to offer, but there are so many other ETFs, including the Disruptive Innovation ETF by ARK Invest, the airline industry ETFs such as Jets, and many more. If there's a specific industry you want to invest in, then there probably is an ETF out there. An ETF is a fantastic way to invest because instead of purchasing individual companies and picking which ones are going to succeed, you diversify and purchase the entire industry. If one company in an ETF tanks, it's alright because another company in the ETF may skyrocket. ETFs are a fantastic investment vehicle that you should consider adding to your investment portfolio. Let me know which Vanguard ETF you like, and let's continue this conversation in the comment section below. Peace.